fair bit of cut. Nifty as we speak is down 0.1% at below 22,500 levels. All right, Nifty is currently trading below the 22,500 mark. There is, however, been a recovery in the broader markets. Both indices were trading in the red this morning, but they have in fact clawed back all that was lost and are moving higher. Nifty mid cap as we speak is back above 49,800 level, and the small cap index is also back in the green. It's trading above the 16,227 mark. But the decision overall, I think, as far what the expectations are, the market and the analysts, all of them are expecting a status quo, Karthik. So largely it will be a non-event unless there is some hawkish undertone to what Mr. Das is really saying.
You're right, Suyash. I think, and hi, good morning to you. I think, it's definitely nothing out of the blue which is expected from this MPC. Remember, RBI had hit the pause button for the first time in February last year. It's been more than a year, in fact, about 14 odd months that we've been stuck at that 6.5% interest rate. And while there is a hope that there is going to be at least some signaling of a rate cut sometime soon, I think the 5th of April Monetary Policy Committee decision, which is going to be announced shortly by Shaktikanta Das, is not going to be in favor of a cut.
All right, Mr. Das has started speaking. Let's listen in to what the governor has to say.
Charged its responsibility with integrity and professionalism. Compared to many other central banks, the Reserve Bank has a much broader range of functions, which is vital for ensuring macro-financial stability of a modern and complex economy like India. There are functional complementarities among the various responsibilities of the Reserve Bank of India. Being a full-service central bank, the Reserve Bank is well positioned to take a holistic view of various critical issues confronting the economy and the financial sector, and it's also well positioned to take appropriate steps in the best interest of the economy. We continuously strive to learn, adapt, and innovate while performing our multiple responsibilities. I would now like to focus on the decisions and deliberations of the Monetary Policy Committee meeting, which met on 3rd, 4th, and today, 5th of April. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Reserve Bank MPC decided by a majority of 5-1 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF, rate remains at 6.25%. and the marginal standing facility, that is the MSF rate, remains at MSF rate and the bank rate, they remain at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, the growth inflation dynamics have played out favorably. Growth has continued to sustain its momentum, surpassing all projections. Headline inflation has eased to 5.1% during both January and February, and this has come down to 5.1% in these 2 months from the earlier peak of 5.7% in the month of December. Core inflation has also declined steadily over the past 9 months to its lowest level in the series. The fuel component of CPI remained in deflation for 6 consecutive months. Food inflation pressures, however, accentuated in February. Looking ahead, robust growth prospects provide the policy space to remain focused on inflation and ensure its descent to the target of 4%. As the uncertainties in food prices continue to pose challenges, the MPC remains vigilant to the upside risks to inflation that may derail the path of disinflation. Under these circumstances, monetary policy must continue to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission of the past monetary policy actions. The MPC therefore decided to keep the policy rate unchanged at 6.5% in this meeting and also remain focused on withdrawal of accommodation. The MPC will remain resolute in its commitment to aligning inflation to the target. I would now like to provide an assessment of growth and inflation, and I will begin with the scenario relating to global growth. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Now, in my statement, whatever I am saying, it is backed up with a lot of data which are there in the footnotes. So those of you who are interested could refer to this statement, which as usual will be uploaded in the RBI website immediately after this statement is over. So a lot of data backing up whatever I am saying is available in the various footnotes of my statement. You may like to refer to it. Let me start again on the global growth part. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Global trade is expected to grow faster in 2024, although weaker than its historical average. Inflation is moving closer to targets, but the last mile of disinflation is turning out to be challenging. Services inflation in advanced economies remains sticky amidst tight labor markets. Accordingly, central banks are cautious in their communications, thereby tempering market expectations about the timing and magnitude of interest rate cuts later during this year. Equity markets have gained while bond yields and the US dollar have remained volatile. The overall outlook is challenged by continuing geopolitical conflicts, disruptions in trade routes, and high public debt burden. In the last monetary policy statement, if you recall, I had expressed concerns about the high levels of public debt in both advanced and emerging market economies, that is the EMEs. These are dormant risks which could erupt abruptly. Debt to GDP ratio, which rose during the pandemic, remain elevated and are projected to increase further with rising interest burden and cost of borrowing, thus raising debt sustainability concerns. Worsening debt situation in advanced economies, in particular, can generate spillovers for the emerging market economies in the form of swings in capital flows and volatility in financial markets. The emerging market economies with rising levels of public debt in particular would be vulnerable to these spillover effects. Credible fiscal consolidation plans, particularly in major advanced economies, focusing on growth enhancing investment would be necessary to address this challenge, not only for themselves, but also I think for the overall global economy. India, however, presents a different picture on account of its fiscal consolidation and faster GDP growth. Turning to domestic growth, the domestic economic activity continues to expand at an accelerated pace, supported by fixed investment and improving global environment. The second advance estimates placed the real GDP growth at 7.6% for 2023-24, the third successive year of 7% or higher growth. From the supply side, industrial activity led by manufacturing continued its momentum. The Purchasing Managers Index, that is PMI for manufacturing, displayed a sustained expansion in both February and March, touching a 16-year high in the month of March. Services sector exhibited broad-based buoyancy with all sectors within the services sector registering strong growth. The PMI services remained above 60 during February and March, suggesting sustained healthy expansion. With rural demand catching up, consumption is expected to support economic growth in 2024-25. Urban consumption stayed buoyant, as evident from various indicators. Details are given in the footnote. The resilience in cement production, together with strong growth in steel consumption and production and import of capital goods, augur well for the investment cycle to gain further traction. The total flow of resources to the commercial sector from banks and other sources at rupees 31.2 lakh crore. I repeat, at rupees 31.2 lakh crore during 2023-24 is significantly higher than that of the previous year, which was 26.4 lakh crore. External demand improved in February, with exports registering double-digit expansion. Trade deficit, however, widened in February as imports also accelerated. Going forward, the outlook for agriculture and rural activity appears bright, with good Rabi wheat crop and improved prospects of Kharif crops due to expected normal southwest monsoon. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. Let me read this sentence again because there are quite a few points in this. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. As per our survey, consumer confidence 1 year ahead reached a new high. The prospects of investment activity remained bright owing to upturn in private capex cycle becoming steadily broad-based. Persisting let me just rephrase it. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, and rising capacity utilization, and finally strengthening business optimism as reflected in our surveys. I think the sentence is a bit long. It's better that I read it out again for greater clarity. And sorry about that, but I think it provides greater clarity. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, rising capacity utilization, especially in the manufacturing sector, and strengthening business optimism as reflected in our surveys. Improving global growth and trade prospects, coupled with our rising integration in global supply chains, are expected to propel external demand for goods and services. The headwinds from protracted geopolitical tensions and increasing disruptions in trade routes, however, pose risks to the overall outlook. Taking all these factors into consideration, the real GDP growth for the current financial year 2024-25, which started on 1st April, the real GDP growth for 24-25 is projected at 7%, with Q1 at 7.1%, Q2 at 6.9%, and both Q3 and Q4 at 7% each. The risks are evenly balanced. Turning to inflation, food price uncertainties continue to weigh on the inflation trajectory going forward. A record Rabi wheat production would help temper price pressures and replenish the buffer stocks. As you would recall, the buffer stocks had slightly dipped, but I think the record Rabi production of wheat is expected to replenish whatever depletion had taken place. Moreover, early indication of a normal monsoon augurs well for the Kharif season. International food prices also remain benign. The tight demand-supply situation in certain categories of pulses and the production outcomes of key vegetables warrant close monitoring, especially in the background of the forecast of above normal temperatures in the coming months. And these above normal temperatures, as per the current forecast, are expected to prevail in April, May and June, and not beyond June. That is the current forecast. Frequent and overlapping adverse climate shocks pose upside risks to the outlook on international and domestic food prices. Cost push pressures faced by firms are seeing an upward bias after a period of sustained moderation. Deflation in fuel is likely to deepen in the near term, following the cut in LPG prices in the month of March. Notwithstanding the cut in petrol and diesel prices in mid-March, the recent uptick in crude oil prices, especially in the recent few days, they need to be very closely monitored. Continuing geopolitical tensions also pose upside risk to commodity prices and supply chains. Assuming a normal monsoon next year, CPI inflation when I say normal monsoon for next year, I mean the current year 24-25. CPI inflation for the current year 24-25 is projected at 4.5%. I repeat, CPI inflation for the current year 24-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have explained the growth situation, I have explained the inflation scenario. Synthesizing everything, what does it mean? What implications it has for monetary policy? And that is precisely what I would like to explain now. Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished. The success in the disinflation process so far should not distract us from vulnerability of the inflation trajectory to the frequent incidence of supply-side shocks. Our effort is to ensure price stability on an enduring basis, paving the way for sustained period of high growth. I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I had mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, Liquidity situation improved in March with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning variable rate repo operations, that is VRRR operations during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through variable rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated. Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRRR auctions. On 2nd April, then again we did it on 3rd April. So last 2-3 days we have been doing it. And today, as you know, there is a variable rate, there is a what you call, as per our cycle, we are doing VRR operation for 14 days, a VRRR operation for 14 days. Now, reflecting these liquidity developments, the weighted average call rate, that is WACR, exhibited a softening bias and has hovered near the repo rate since the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive as reflected in reduced term spread in the G-Sec market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few advanced economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvements in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital and asset quality of scheduled commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players by and large operate with public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. They should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority (RRA) 2.0 constituted by the Reserve Bank have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review Authority which was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape. Turning to external sector, during the first 3 quarters of 23-24, India's current account deficit narrowed significantly on account of a moderation in merchandise trade deficit, coupled with robust growth in services exports and strong remittances. India's merchandise and services exports have grown at a healthy pace in the 4th quarter of 23-24. India continues to be the largest recipient of remittances in the world. The cost of receiving remittances is gradually coming down. Overall, the current account deficit for 2024-25 is expected to remain at a level that is both viable and eminently manageable. On the external financing side, India's foreign portfolio investment, that is FPI flows, saw a significant turnaround in 23-24. Net FPI inflows stood at $41.6 billion during 23-24, as against net outflows in the preceding 2 years, which were in the order of 14.1 billion outflow in 21-22 and 4.8 billion outflow in 22-23. This is the second highest level of FPI inflow after 23-24. Net foreign direct investment moderated to $14.2 billion in April-January 23-24 from 25 billion a year ago. External commercial borrowings, that is ECBs, and non-resident deposits recorded higher net inflows compared to the previous year. The amount of ECB agreements also grew markedly in 2023-24 up to February 24. Now all this data is given, details are given in the footnote. India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29th this year, March 29, 2024. I repeat, India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. Latest data on various external vulnerability indicators suggest improved resilience of India's external sector. We remain confident of meeting our external financing requirements comfortably. Now, talking about the forex reserves, I recall that in 2021 our forex reserves had also reached 642 plus billion Then following the commencement of the war in Ukraine and the outflow of dollar from India as well as from several other countries on safe haven demand, there were concerns that forex reserves of India was going down, and at one point it had gone down. Our forex reserves had gone down to about $524 billion. And at that time, I think several questions were raised about, what was RBI doing, whether RBI was on the right track. If you recall, at that time, we had very clearly assured that the decline in forex reserves was partly due to, the change in valuations of our assets, and also partly due to our intervention in the market to ensure an orderly depreciation of the rupee, which is a part of our policy, ensuring orderly depreciation or orderly appreciation. And we had that time very clearly and firmly stated that we are using our forex reserves in a very judicious manner. It was a strong umbrella which we had built up, and we are using it because it was raining heavily, and we were mindful of what we were doing. We knew what is our purpose and in which direction we are moving. And as you would see, now the reserves have again risen, and they stand at an all-time high of 642.6 billion US dollar, 645.6 billion as of 29th March. So, this is one area on which the Reserve Bank remains committed. Number one, to sort of ensure that, the exchange rate of the rupee is market determined. There are inflows and outflows of dollars happening, but it is our focus, it is our prime focus to build up a strong umbrella, a strong buffer in the form of a substantial quantum of forex reserves, which will help us when the cycle turns or when it rains heavily. So let me move forward. Sorry for that digression, but I thought it was necessary to set the record straight. I shall now announce certain additional measures. The first announcement relates to trading of sovereign green bonds in the International Financial Services Center, IFSC. With a view to facilitating wider non-resident participation in sovereign green bonds, a scheme for investment and trading in these bonds in the IFSC will be notified very shortly. The second announcement relates to the RBI Retail Direct Scheme and introduction of a mobile app to operate in the RBI Retail Direct Scheme. The Reserve Bank Retail Direct Scheme was launched in November 2021 for enabling the retail investors to participate in the GSEC market, both in the primary as well as in the secondary market auctions and operations. It is now proposed to launch a mobile app for accessing the Retail Direct portal. This will be of great convenience to retail investors and deepen the GSEC market further. The next announcement relates to review of liquidity coverage ratio, that is LCR framework. Technological developments have enabled bank customers to instantly withdraw or transfer money from their bank accounts. While improving customer convenience, this has also created challenges for banks to deal with potential situations when, due to certain factors, a large number of depositors decide to instantly and simultaneously withdraw their money from the banks. The developments in certain advanced jurisdictions during the last year demonstrated the difficulties it can create for banks. The difficulties it can create for banks to deal with such situations when there is heavy outflow of heavy outflow or transfer of deposits. And this happens only if that particular bank is in an acute stress. It's not a normal thing which happens, but then the banks will have to remain prepared for all eventualities. A need has therefore arisen to undertake a comprehensive review of the LCR framework for banks. A draft circular will be issued shortly for stakeholder consultation. Our approach is to have
Hello and welcome, you're watching Business Plus. I am Suyash Maheshwari and with me in the studio is Karthik Malhotra, and the verdict is out. RBI has left policy rates unchanged for the 7th consecutive time, with 5 out of 6 members voting to both hold the rates and maintain status quo as far as the stance goes, which is, by the way, withdrawal of accommodation. Overall, Karthik, nothing out of the ordinary. Rather, Mr. Das was sounding bullish, but for the half-empty guys out there, 2 things stood out for me. One, high public debt, and inflation, inflation trajectory, especially considering that oil is back on the rise. It's back above $90 a barrel.
So I think RBI Governor Shaktikanta Das said very clearly that oil prices is something that the RBI MPC is looking at, very, very vigilantly. At the same time, other geopolitical events are also being factored in. And as far as inflation projections for this financial year FY25 go, he also said that a lot is dependent on the monsoon. Now, these are all issues that obviously become part of any decision that the central bank has to take. Now, my fear right now is, you're right, I think there's nothing out of the ordinary. 6.5% stays, so that pause on MPC on rate decisions taken in Feb 2023 continues even in April 2024. Now, inflation for Q1 of FY25, which is this quarter that we are sitting in, is likely to ebb down but still be well above the 4% range at about 4.9. It's only in Q2 that you're looking at inflation coming down, the CPI inflation coming down to about 3.8, which is just marginally below the 4% threshold that the RBI wants to hammer inflation down to.
Right.
But the point is, for the entire financial year, with a normal monsoon and with oil prices and geopolitical events in check, we are still looking at 4.5% inflation, which is much higher than RBI's threshold of 4%. And the fact that the stance has not been changed from withdrawal of accommodation to neutral means that perhaps for the foreseeable future, a rate cut is not on Shaktikanta Das's anvil.
All right, but not a unanimous decision at that. I mean, one member still voted in favor of a rate cut and maybe a change in stance as well. But, I'm looking at the markets and they have reacted rather positively to what Mr. Das had to say. And, to really understand what the market is thinking now. And let's also bring on board our technical expert, Kush Bohra, founder at kushbohra.com. Hi, Kush. Thank you for joining us here on News 9. I mean, the markets overall, they are happy with what Mr. Das had to say. A strong recovery. Nifty has recovered from, about 80 points from the day's low. It's back near that 22,500 levels, which, by the way, is where we have hit brick wall time and again. We have reverse course multiple times now from that 22,500 zone. What's your, overall assessment of where we stand?
Hi, first of all, very good morning to both of you and to all the viewers, and a very happy Friday. I think yesterday's move aside, where the markets actually shot up quite a bit, and we were seeing some sort of a momentum pick up in some way. What's interesting is that if you go back to December, the momentum indicators have made a high, right? And every high that the markets have made ever since, the momentum indicators haven't picked up. In short, what I'm referring to is what we call a negative divergence, where the prices shoot up, but the momentum, indicator for the strength, suppose, if you call it that, seems to be missing. Now, while our, best case scenario on Nifty from, let's say, 1 to 2 month perspective is 22,800, 22,500, by the way, was our first target for April. It's been hit fairly early. The second target that we have on Nifty is 22,800. But we are taking it with a pinch of salt. We aren't going too aggressive on the highs. The buy on dip strategy has been working in the market and will continue to pursue that. So any kind of dip towards, let's say, the 20 to 300 mark, or even the 20 to 400 mark is where we will enter more. My concern is that the momentum is missing. If that doesn't pan out, and if you have any kind of negative trigger, the market might just consolidate sideways, if not a breakdown, because time and again we've seen buying come in at lower levels. So the 20 to 800 target remains. Buy on dips is the strategy, but it might just happen that we might trudge along rather than make a big dash towards that. So that's the view on Nifty at least.
All right. Teresa John, Deputy Head of Research and Lead Economist at Nirmal Bang, is also joining us. Thank you for joining us here on News 9, Teresa. The verdict is out, status quo as was expected by the market. What stood out for you, and anything that Mr. Das said that would, perhaps suggest when that first rate cut would come?
Yeah, so it is largely a status quo policy, as you rightly said. So I think our rate cut expectations are now getting pushed back both globally as well as domestically, because growth has remained resilient. It seems like, at least in the first half of FY25, it will be difficult to see rate cuts now. mainly because even though inflation will come down in the second quarter to around 3.8%, the RBI itself has reduced its inflation forecast from below from 4% to 3.8% now. But you probably will have those numbers in 3Q FY25. So that's when we probably will see rate cuts, at least in our view.
Sir, good morning. Karthik here. I want you to throw some light on the other external sort of circumstances that Governor Shaktikanta Das mentioned, which includes oil prices, which includes other geopolitical events, and of course a good monsoon. So 3.8 coming in Q2, but the annual projected CPI inflation for FY25 still at 4.5%. Considering oil remains where it is, doesn't inch any higher than that. Geopolitical events continue as as expected, and a monsoon also becomes benevolent. So, I mean, are we really looking at any sort of a decisive rate cut action anytime in the financial year?
Our base case is predicted on the fact that probably the global central banks will cut rates, sometime post June. And you probably will, if you're looking at 4.5% inflation and 6.5% repo rate, then they're basically sitting at a 2% real interest rates, which is quite high for an economy like India. So you're right that potentially if, food prices could remain volatile, as the governor himself has highlighted. Oil prices, there are geopolitical risks, so probably will not come down substantially. So there are some upside risks to inflation, but probably inflation even then will stay in the 4.5% to 5% range, mainly because core inflation, which is still about 45% of inflation, remains quite benign even at this point in time. It's around 3.2, 3.3%. So if you have a situation of high real interest rates, and that can impact growth with a lag, so you're not seeing any significant impact on growth, at least in the near term. The high frequency indicators continue to suggest a robust economy. The RBI is predicting around 7% growth. We are slightly lower, but I think there is an upside risk to our own estimates. So from a growth perspective, there is no real need to cut rates in the immediate future. But what you could have is probably going into the second half of FY25, if inflation does see some moderation and you are in a situation of say 1.5% to 2% real rate, that does give you room to cut rates a little in line with what global central banks are doing. But in the near term, I agree with you that there is no real need to cut rates, looking at the inflation trajectory and given that growth remains robust.
All right, and Kush, I'll come back to you. I mean, oil prices, that part of the inflation equation is back on the rise. We are back above $90 a barrel on Brent crude, up 20%, on a year-on-date basis. I mean, what's going on here, and can we perhaps move towards that $100 a barrel mark? Because a lot of this surge, that it's coming on the back of what's going on in the Middle East, which is again responsible for 1/3 of all the oil supply.
True, and if you do look at the the medium-term chart, what you will find is the fact that this is perhaps a mark where we've seen the recent highs. So I think this is perhaps one level where crude could stop for some time, consolidate. The trajectory is north, but the kind of supply zones that come in at around these levels do tend to sort of bring it down from here. So there is a possibility that we may perhaps hover around the 90 mark, but I don't see too big an upside from here on, at least for the coming month.
Teresa, I want to bring you back into this conversation on oil, and another reason why oil is seeing a bit of a spike right now is because of some recovery of demand in the US. Now, if the US demand recovery continues to be sustained and India continues to be in a high interest rate regime, are we looking at a scenario in FY25 of FII as well as FPI money perhaps flowing out into the US from India, which has so far been the flavor of the season?
So if you see, the equity market rally is largely being led by domestic investors more than the foreign investors. But you're right, in the first quarter of FY24 and in the fourth quarter of FY24, you did see FPI flows, contributing to the rally. So my sense is that if the US starts cutting rates and liquidity remains favorable, India should continue to see flows. US demand impacting oil prices, yeah, I mean, I think it's more a function of geopolitical risk than US demand per se, because I think US is now a net, exporter of energy in the energy basket. And if you do see oil prices, remain at these levels or go up from here, you could see domestic production in the US as well increase. So I don't think the US in itself over a medium term is going to be a significant contributor to higher oil prices. It's mainly the geopolitical concerns coupled with the sustained cuts from OPEC, which is keeping oil prices where it is.
All right, and speaking of, the Fed and US, do you think RBI will perhaps wait for, to take cues from the Fed before going for a rate cut, to keep the bond market happy? Because the differential between the yields here and the yields in the US have been like pretty much squeezed out. It's currently at about 3.5% post-COVID. Before COVID, it used to be around that 5 to 6%, that spread used to be 5 to 6%. Do you think that, RBI is also trying to keep the bond market happy?
So you're right that the spreads have compressed to around 3% now. Earlier, it used to be in the range of 4.5 to 5%, but that's also reflective of India's domestic fundamentals. Our inflation numbers, that spread between the US has also come down. Our current account deficits, our fiscal deficit, all remains at manageable levels. So it is partially reflecting India's better macroeconomic fundamentals, and also you have support from the JP Morgan bond inclusion and eventually the Bloomberg bond inclusion, that will support flows into India. I don't think the RBI will move before the Fed, given the current growth inflation dynamics. There is no need to cut rates from a growth perspective. So I think probably it will be in the sequence of rate cuts from global central banks. You already seen the Swiss National Bank cut rates last week. Probably you will see the ECB cut rates by June. Probably Fed slightly after that, and I think the RBI in that will be kind of following the Fed.
Okay, Kush, I want to get you in here. The annual growth in the second revised estimate, which Governor Shaktikanta Das mentioned for FY24, expected to come in at 7.6%. Now, this is pretty close to what World Bank a few days ago had projected, 7.5%. But many economists out there suggesting that the actual growth for the gone by financial year should come in at about 8%. Do you think RBI is being a little pessimistic on its outlook for growth numbers for FY24?
I think in all honesty, perhaps Teresa is, better place to answer that.
Okay, let's get Teresa in. Teresa, is the RBI being a realist or a pessimist at projecting growth at 7.6?
So the RBI has basically taken the number which has come from the government in the second advance estimates. My own number is at 7.5, but I do see, given the high frequency indicators that we are tracking, I do see upside risk to my estimates. So probably it will be in the range of 7.5 to 8%, maybe slightly above 7.6%, looking at the current state of affairs.
Okay, and a 7% target for FY25, are we on track to meet that? Given the fact that this is election year and post June, July, we may actually encounter a situation where the government is spending less on infrastructure development and capex.
So yeah, the 7% looks a little bit optimistic to me, but again, globally growth is proving more resilient than expected. So everyone is expecting a US recession now. That scenario seems to be completely out. Probably, I mean, even the Fed is not even actually projecting any substantial slowdown. So if global growth is supportive, probably we could do close to 7%, somewhere in the range of 6.5 to 7%. Capex spending, I think once the government comes back to power, you will actually probably see a pickup in spending. Maybe till the elections are over in the first quarter, you might actually see some slowdown in spending that you usually see in government spending. But probably, I think the capex focus of the government is here to stay.
All right, and Kush, circling back to you, I mean, Mr. Das also spoke about, how the rural demand has been sluggish, and also, they are keeping a close track on, how the monsoon pans out. But we had the Q4 business updates of Dabur out yesterday, and I mean, that is one company that operates across, multiple segments in that FMCG bracket, personal care, health care, home care, food products, among others. I mean, from their business update, it looks like they are expecting, sluggish volume growth once again. So can we draw any inferences, as to how this, the quarter will pan out for these FMCG names?
I think the writing's there on the wall for a lot of these names. I mean, if you see, the likes of, HUL, Britannia, maybe, in some parts had actually tried to perhaps, shine, but then gave way. So I think a lot of these names, the writing's on the wall. There hasn't really been as much of an, uptick, at least from a price perspective. If you talk specifically of the Dabur stock price per se, then it's, back where the October lows were and, breaking below that. So for me, I think the sluggishness in this space will continue. The only couple of stocks that we like in this space are Tata Consumer and ITC. Tata Consumer from a momentum perspective and ITC more so from a wealth preservation perspective. But other than that, I think, as I said, the writings on the wall, there is a possibility that, tougher days are ahead for, a lot of stocks in this space.
All right, and another sector I wanted to pick your brains on is the banking space, and it's leading the charge from the front this morning. Nifty Bank, as we speak, is back above that 48,000 mark. It's back above 48,000 after a gap of nearly 3 months. And HDFC Bank is leading the charge, Kush. I mean, the Q4 business updates came out. Healthy growth across the board, but deposit growth, I mean, that was the pain point, for these large cohort of private banks, that the numbers were quite, good out there. 26% year-on-year rise, 7.5% quarter-on-quarter rise. I mean, do you expect, other private banks to, post also good numbers, and could they take the leadership going forward? Because Nifty has been lacking, leadership.
Well, again, from primarily a price point movement, HDFC Bank, I mean, we did have this as a long-term call as a part of our advisory service, and today the target one was hit. We are still bullish on this, for the target two of 1600 plus kind of level. But if you ask me, I think there is a lot of room here. The recent highs that it made, 1700, I think that's a very that should be, if not, walk in the park, it should still be an easy up move for the bank. It has a lot of catching up to do. But as far as the other private names go, I think, ICICI Bank is one stock that I'll have on my radar. But other than that, it gets a little thin out there. Then, you have to look over at the PSU names. So for the likes of SBI, Canara Bank, and PNB in the smaller ones, these are some of the stocks that we have on our radar from the banking space. Also, let's not forget one thing that, if you talk about the index alone, Bank Nifty, we've been seeing this outperformance for the last couple of sessions, on the Bank Nifty. But truth be told, we all know that this is actually more of a catch-up rally. Nifty is already at its all-time highs. Bank Nifty still some striking distance away. But I think we'll get there. And the fact that, the big boys are supporting is an encouraging sign for both Nifty and the Bank Nifty. So this catch-up rally might continue, 48,600 being the near-term target that we have on Bank Nifty, the recent high. But once that is taken out, 49,200 also is something that we have on our radar.
Okay, and since you guys are talking banks, let me also bring in Teresa once again. Teresa, very closely linked to banks is also the Forex, and RBI governor mentioning that India's Forex, US dollar reserve war chest of about $645 billion, up from $642 billion or so seen in the year 2022. How significant is it? And do you think the government is, and the central bank is becoming a little too meddling in the affairs of the free value of the rupee? I mean, is it not fair to let the rupee depreciate to its real value so we can extract the maximum out of our fairly robust goods and services exports?
So, yeah, I think the reserves remain robust. That is a point of support to the rupee, at least from a macro fundamental perspective. I don't think the RBI has been extremely interventionist when it's coming to the rupee, but when compared to other central banks, probably that is the case. But I think compared to most market participant expectations, the rupee has actually been weaker. We think the moderate depreciation trend is here to stay, but probably what the RBI does not want is a very sharp depreciation. But again, the macro fundamentals also do not suggest that there will be very sharp depreciation. So we look at the FX reserves per se, if you look at the current account deficit, all of that suggests that the rupee will be relatively stable going forward.
Right, that's Teresa John for you. Thank you for giving us time here on News 9. And Kush, always great insights from you as well, sir. Thank you both for giving us time here on Business Plus. But with that, it's a wrap on this edition of Business Plus. We'll see you at 4 p.m. with Last Tick.
You were the chosen one to direct Mr. Bachchan for his first endorsement, for his first appearance on the small screen.
It was a life-changing moment.
Have you been a rebel with a cause?
There was a sense of responsibility